This past week, Amazon stock took a dive after the company announced a record-breaking spending plan for the year. The move has investors asking, is the tech giant making a bold bet on the future, or is it spending too much, too fast? Welcome to Ticker Watch News for Amazon, Week 6, 2026. This episode covers the latest news and market developments for the company. It was a tough week for Amazon stock, which saw a decline of over 12%. The drop came even as the broader market saw milestones like the Dow Jones Industrial Average closing above 50,000 for the first time. The tech sector as a whole faced a sell-off, and Amazon was caught in the downturn, shedding more than $310 billion in market value since Monday. The biggest news driving the week was Amazon's fourth-quarter earnings report. While the company's revenue of $213.4 billion beat analyst expectations, its earnings per share came in just shy of estimates. More importantly, the outlook for the first quarter of 2026 suggested operating income might be lower than what Wall Street was hoping for. The main headline that grabbed attention was Amazon's plan to increase capital expenditures to around $200 billion for 2026. This is a significant jump from the roughly $125 billion spent in 2025. The company stated the investment will focus on expanding its infrastructure for artificial intelligence, custom chips, robotics, and its low Earth orbit satellite project. A majority of the spending is directed towards its cloud division, Amazon Web Services. Despite the market's reaction to the spending plan, the Amazon Web Services, or AWS division itself showed strong performance. The unit's revenue grew 24% in the fourth quarter to $35.6 billion, its fastest growth rate in 13 quarters. The backlog for AWS now stands at $244 billion, up 40% from the previous year, indicating robust demand for its cloud services. In other news, the company is facing new regulatory pressure in Europe. German authorities issued a ruling against Amazon's marketplace practices, prohibiting the company from setting price controls for third-party merchants and ordering it to repay around €59 million in what it called unfair gains. And finally, Amazon confirmed it is cutting an additional 16,000 jobs as part of a broader restructuring. The company is also closing its Amazon Fresh and Amazon Go stores, with plans to replace some of them with Whole Foods locations. The market's reaction to Amazon's spending plans was immediate and negative, with the stock falling as much as 10% in a single day. Investors appear concerned about the impact of the massive capital outlay on near-term profitability and free cash flow. Analysts are divided. Davidson downgraded the stock to neutral from buy, lowering its price target to $175 from $300, expressing concern that AWS is losing its lead to competitors. In contrast, Bank of America, while lowering its price target slightly to $275, maintained a buy rating, suggesting the investment in capacity is necessary to maintain its leadership in the cloud sector. Other analysts have suggested the sell-off could present a buying opportunity for long-term investors. Overall, the sentiment is mixed, with worries about short-term costs clashing with potential long-term AI-driven growth. From a technical perspective, the sharp sell-off pushed the stock into what some analysts call oversold territory based on its relative strength index. On the fundamental side, the narrative has shifted. With the stock's recent drop, it is now trading at what some reports describe as its cheapest forward price-to-earnings valuation in the last decade. The company's return on invested capital has been increasing, a metric that suggests an ability to turn investments into profits. The bull case is that this heavy spending cycle is a necessary investment to build a dominant position in AI, similar to how the company invested heavily in AWS in its early days. The bear case centers on the risk that the massive spending will pressure cash flow and that returns on this AI investment may take longer than investors are willing to wait. Looking ahead next week, market watchers will be closely monitoring how Amazon's stock price stabilizes after this week's drop. Continued commentary from analysts on the long-term implications of the $200 billion spending plan will be a key focus. The bull case scenario is that investors will begin to see the spending as a long-term positive, leading to a stock recovery. The bear case is concerns over profitability will continue to weigh on the stock, potentially leading to further declines. The base case likely involves a period of volatility as the market digests the full impact of Amazon's aggressive investment strategy. Thank you for tuning in to Ticker Watch. This podcast is for educational and informational purposes only and does not constitute financial advice. Please consider subscribing and leaving a review to help others find the show.